In July 2023, there's a good chance your bank mailed you a notice. It showed up in the same pile as credit card promotions, loyalty program offers, insurance flyers, and supermarket coupons. You probably saw the envelope, recognized the bank logo, and either tossed it aside or skimmed the first line before moving on with your day. What almost nobody realized is that this boring letter quietly described the biggest structural shift in American banking in half a century. The entire way your money travels through the financial system began to change, but the update was written as if it were just another technical adjustment, the kind of routine maintenance banks do all the time. Think about the mail you get from your bank. Privacy notices, fee updates, revised terms and conditions, changes to overdraft policies, new rewards information. We've all been conditioned to treat those pages of legal text as background noise. This time, though, that background noise carried a message that should have been front-page news. Your account was being moved off traditional private banking rails and plugged directly into infrastructure operated by the Federal Reserve. To see how significant that is, we need to walk through the timeline. On July 20th, 2023, the Federal Reserve officially launched something called the FedNow service. FedNow was presented as a modern instant payment platform, a way to make transfers settle in seconds instead of days. But FedNow wasn't just an add-on to the existing system. In practice, it began to replace the automated clearinghouse, ACH network that had moved money between American banks for more than 50 years. 4 days later, on July 24th, customers of Webster Bank opened their mailboxes and found a neatly formatted letter announcing new enhancements to their accounts. Here's where the messaging strategy becomes clear. The Webster Bank letter focused heavily on reassuring you that almost nothing in your daily routine would change. Your account number would remain the same. Your direct deposit would continue to land on schedule. Your debit card would still work at stores and ATMs. You'd keep access to a large nationwide ATM network through MoneyPass with over 40,000 machines. If you just skimmed the bullet points, the message was simple. Everything you like stays the same, and a few things get better. But the crucial details were buried in the attached disclosure, written in dense technical legal language. There, Webster quietly explained that your transactions would no longer be clearing exclusively through private bank systems. Instead, payments would now move and settle using Federal Reserve master accounts via the FedNow infrastructure. In other words, every dollar you send, receive, or transfer now travels across rails that are operated and overseen directly by the central bank. This means the federal government is no longer merely supervising the banking system from above. It sits at the center of the network, processing the payment traffic that used to flow primarily between private institutions. We have seen this kind of shift before. Back in August 1971, President Richard Nixon went on national television to announce that the United States would temporarily suspend the convertibility of dollars into gold under the Bretton Woods system. He reassured the public that their everyday lives would continue as usual. Paychecks would still be issued in dollars. Savings accounts would still be denominated in dollars. Stores would still accept dollars. But behind those calm words, the core nature of the system had changed. We moved from money anchored to gold, to a pure fiat currency model, where the value of the dollar rests entirely on government promises and central bank policy. What's happening now with FedNow is a similar pattern, but applied to payment infrastructure instead of gold convertibility. Another major regime change is being framed as a harmless upgrade. This time, though, your consent is more symbolic than real. You're not being asked whether you want to participate. You're simply being told, in complex language most people will never read, that your account will now operate on a different kind of backbone, one controlled by the Federal Reserve. Ask yourself honestly, when was the last time you sat down and read a full multi-page banking disclosure from beginning to end? The overwhelming majority of people don't. Banks know this. Regulators know this. That is exactly why this seismic shift was delivered in the form of routine notices and fine print. It allowed millions of accounts to be migrated onto FedNow infrastructure with almost no public awareness or debate. The timeline and preparation confirm that this was deliberate, not accidental. The Federal Reserve did not throw FedNow together as a quick response to some short-term crisis. It announced the project in 2019. Over the next 4 years, the Fed designed the system, built the technology, ran pilot programs, coordinated with payment processors, and prepared banks for integration. This was a multi-year strategic rollout. The only remaining problem was how to move regular customers onto this network without triggering headlines or concern. Webster Bank's letter is a case study in how that problem was solved. For the rare customer who read past the marketing language about enhancements and the MoneyPass network, the disclosures contained the key. Your account would now rely on FedNow and Federal Reserve Master Account infrastructure. At the same time, the letter emphasized features like instant transfers and 24/7 access. Those are good things, right? Faster payments, no more waiting for weekends or holidays to clear. But pause and compare that pitch with what you already had. Apps like Venmo, Cash App, PayPal, and bank-backed systems like Zelle were already providing real-time or near real-time transfers for millions of Americans. The problem to be solved wasn't that instant payments didn't exist. It was that the instant payments most people were using were built on private platforms that didn't give the Federal Reserve direct, real-time control over every transaction. What FedNow really changes is the architecture. Your checking account is no longer just part of a network of private banks whose relationships are mediated by older systems like ACH. It is now plugged into a unified set of rails operated by the central bank. When you send money to pay your credit card, your utility bill, your landlord, or your savings account, the transaction settles through FedNow and the Federal Reserve's master account system. That carries serious implications for privacy and autonomy. Before FedNow, if the federal government wanted a detailed look at your personal banking activity, it generally had to go through legal channels, subpoenas, warrants, court orders, or national security letters. Banks held your transaction records and served as intermediaries. In some situations, they could push back or at least insist on proper legal process. With FedNow embedded as the payment backbone, the distinction between regulating the system and running it begins to blur. The Federal Reserve processes transactions in real time. It doesn't have to ask for access to information it is already handling. The data is baked into the system's operation. But there's another layer to this story that goes even deeper. That letter you received in July 2023 did more than plug your account into FedNow. Hidden in the legal phrasing, it also granted broad consent for enhanced digital payment services and future innovations tied to Federal Reserve infrastructure. On paper, that sounds like standard legal boilerplate. In practice, it functions as a pre-authorization mechanism for the next step: central bank digital currency, or CBDC. Central bank digital currency is often marketed as digital cash, but that framing is incomplete. Unlike physical cash, a CBDC can be fully programmable at the code level. Every unit of currency can carry rules, where it can be spent, on what, for how long, and under what conditions. FedNow provides the plumbing that a CBDC would need. Real-time settlement? Check. Centralized processing by the Fed? Check. Connectivity to thousands of banks and service providers through early adopters and processors like Fiserv and the MoneyPass network? Check. The architecture is already in motion. When the Federal Reserve eventually launches CBDC pilots, many of the accounts participating will already be sitting on FedNow rails. The conversion can be presented as a simple upgrade, maybe a new digital wallet tied directly to your existing bank account, promising seamless integration with government payments, tax refunds, or benefits. By that point, most of the legal groundwork will have been laid through terms and conditions that people accepted long before they heard the acronym CBDC. To grasp how calculated this is, look again at how FedNow adoption is spreading. At launch, the Federal Reserve named only a few dozen institutions as early adopters, some regional banks, a few large players, and major processors. But behind those names are networks. Payment processors like Fiserv connect to thousands of smaller financial institutions. When a processor integrates with FedNow, its downstream clients' credit unions, community banks, regional lenders often come along automatically. Take the MoneyPass network, heavily advertised in Webster's letter. On the surface, MoneyPass looks like a convenience offering, a shared ATM network that lets you withdraw cash from tens of thousands of machines without extra fees. But MoneyPass is also a connectivity hub, a way of linking many institutions into a common infrastructure that can be wired into FedNow. So, While customers are focused on the friendly parts of the story, more ATMs, faster access, convenience, the underlying system is being retooled so that more and more account activity flows through Federal Reserve-controlled rails. One of the most consequential design choices in FedNow is the irreversibility of completed transactions. Once a payment has been sent and processed, it generally cannot be pulled back simply by asking your bank. That's a drastic departure from older systems, where ACH transfers could sometimes be reversed and card payments could be disputed or charged back. From the standpoint of a control system, irrevocable transactions are attractive. They create a final, authoritative record that cannot be easily unwound. If funds are frozen, seized, or redirected at the infrastructure level, the ability of individuals or even banks to challenge those actions is sharply limited. Combine that with real-time settlement and the ability to directly credit or debit accounts, and you are looking at the scaffolding of a powerful financial control grid. FedNow also breaks down one of the traditional barriers between citizens and the central bank. Historically, the Federal Reserve dealt primarily with institutions' commercial banks, not individuals. Ordinary people interacted with their local or national banks, which in turn interacted with the Fed. By placing consumer transactions on Fed-operated rails, that traditional separation starts to erode. The central bank moves closer to having a direct operational relationship with your money, even if your account formally remains at a private institution. That's precisely the configuration a CBDC would build upon. Now consider what programmable money could enable once attached to this infrastructure. During the COVID-19 pandemic, we saw how emergency payments and benefits could come with embedded rules and categories funds that had to be used on certain expenses within certain time frames or through certain channels. Those restrictions were implemented via policy and program design layered on top of existing systems. A CBDC system can internalize that logic. The currency itself can be coded with conditions. For example, money that expires if not spent by a fixed deadline. Support funds that can only be used for approved categories like rent, utilities, or groceries. Location-based restrictions that limit spending to certain regions or jurisdictions. Automated penalties or deductions if you engage in prohibited transactions. Under a CBDC regime built on FedNow infrastructure, these scenarios don't require new laws for each use case. They become technical configuration options. Think through what that would mean for your everyday choices. Today, you can still use cash or existing private systems to retain some privacy when you buy politically sensitive books, make donations to controversial causes, travel where you like, or purchase items that regulators might frown upon. In a future where most or all payments are routed through a CBDC, every transaction becomes part of a centrally visible and controllable record. Why would banks cooperate with such a system? The simple answer is that they are heavily regulated entities whose survival depends on access to Federal Reserve services. When the Fed establishes a new standard for core payment infrastructure and signals that this is the direction of travel, banks face enormous pressure to comply. Officially, adoption is voluntary. In practice, opting out of FedNow would mean losing access to the real-time grid that other institutions and customers come to expect. Over time, that's not a viable competitive position. The net result is that participation in FedNow spreads steadily, driven by both regulatory expectations and market dynamics. By 2024 and 2025, more banks will be either directly connected to FedNow or indirectly linked through processors and correspondent partners. Each new integration migrates another slice of the economy onto Federal Reserve rails. At the same time, the off-ramps are narrowing. Before this transformation, individuals who wanted more independence could lean on cash, maintain accounts at smaller banks that move more slowly, or use alternative payment platforms. As FedNow and future CBDCs become more deeply embedded, those strategies become harder to sustain. Cash, especially, will be under constant pressure. It will be portrayed as inconvenient, unsafe, dirty, or associated with tax evasion and criminal activity. Businesses will be nudged toward cashless operations through incentives, then push more aggressively through regulation and compliance burdens. Banks will begin charging higher fees or adding procedural hurdles for handling physical cash. Even if paper currency remains technically legal, it may become so impractical to use that, for most people, It lines up in the same category as writing checks at the grocery store, theoretically allowed, but socially and logistically discouraged. All of this can unfold without a dramatic, headline-grabbing announcement about banning cash or ending private banking. Instead, the system evolves through incremental changes, pilot programs, and quiet letters like the one mailed in July 2023. By the time a full-scale CBDC is launched, which could be framed as a natural extension of the convenience and speed people have already experienced with Fed, now the supporting infrastructure and legal authorizations will largely be in place. Opting out will no longer be easy. The most troubling part is how little open democratic discussion has surrounded these changes. Americans never went to the polls to vote specifically on FedNow or on tying their personal accounts into a centralized real-time payment grid operated by the Federal Reserve. Congress did not conduct a broad national debate about converting the backbone of the banking system to a platform that can support programmable central bank digital currency. Instead, the transformation is happening first at the technical and contractual level. The public conversation, if it happens at all, will arrive after the system is already woven into daily life. If you zoom out, a clear sequence emerges. In 2019, the Fed announced FedNow. From 2019 to mid-2023, the infrastructure was built, tested, and connected to key institutions and processors. In July 2023, FedNow went live, and banks like Webster began migrating accounts using routine notices that most customers never read carefully. From 2024 onward, adoption accelerates as more banks join and more payment processors integrate the new rails. Over time, FedNow becomes the default plumbing for interbank transfers in the United States. Once that foundation is firmly in place, pilot CBDC programs can roll out, likely framed as voluntary tests for select groups such as federal employees, government contractors, or recipients of specific benefits. These pilots will emphasize ease of use, instant settlement, and tight integration with existing bank accounts and digital wallets. If this trajectory continues, by the late 2020s, a central bank digital currency could be positioned not as a radical overhaul, but as a natural evolution of the improvements people have already accepted. Meanwhile, cash and independent digital options become more and more constrained, both by policy and by market reality. At that point, the idea of maintaining financial privacy or autonomy becomes much more difficult. Every dollar you hold, spend, or receive will likely pass through systems where the government not only has visibility, but also the technical tools to influence or limit how that money can be used. Other countries provide a preview of where this road can lead. In China, the digital yuan is being tested and rolled out in phases, tightly integrated with state-controlled banking and social credit systems. European authorities are openly discussing a digital euro with built-in controls and limits, framed as modernization and consumer protection. Each of these projects uses the same basic ingredients: central bank-run infrastructure, always-on connectivity, and the ability to trace and shape transactions at the most granular level. The United States is not copying these models outright, but the underlying logic is similar. Once money is completely digital and the pipes are controlled by a central authority, the temptation to use that control grows over time. At first, restrictions might target only obvious villains: money launderers, terrorists, sanctioned entities. Later, the same tools can be extended to anyone whose behavior is deemed risky, non-compliant, or simply undesirable, according to shifting political priorities. That is why the July 2023 transition onto FedNow rails matters so much. It is not about a single letter from a single bank. It is about a multi-year restructuring of the financial foundation beneath your everyday life. When you understand that, you can no longer dismiss those envelopes from your bank as meaningless paperwork. They are the vehicle through which the ground under your feet is being quietly moved. It all started for many people with a letter they never read. That July 2023 notice was presented as a set of exciting updates and minor technical changes. But underneath the friendly language and promises of more ATMs and faster transfers, it signaled that your account had been wired into a new kind of infrastructure, one that brings your finances into direct proximity with central bank control. FedNow did not simply modernize your payments. It repositioned your bank account as a terminal inside a network operated by the Federal Reserve. quietly laying the groundwork for a future in which money is not just digital, but programmable and subject to centralized oversight at every step.